Over the past couple of weeks and months, enterprise software stocks have been absolutely red hot. Now, one of those stocks that have not caught that bid are shares of Adobe Incorporated, which are down nearly 8% on the year and are sliding another 8.5% after reporting their Q4 results. So we have to take a look at why shares of Adobe really aren't catching a bid. And you see names like Salesforce, ticker symbol CRM, up nearly 35% for the year. You even have shares of Intuit outperforming shares of Adobe by nearly 15% on the year. And of course, don't need to mention names like Palantir that have basically gone parabolic. So we have to dive into what is causing the underperformance in shares of Adobe. In my opinion, it's actually more so to do with the narrative of the stock rather than the fundamentals. Now, some of it is to do with the fundamentals because we got guidance from Adobe that came in slightly underneath what Wall Street was anticipating. We'll be sure to look into that. And then when we get to the technicals, you'll see this one is sliding, call it nearly 8.5%. Again, in the after hours, down to a level of support that has been tested a couple of times over the past, call it, number of years. But at one point or another, you'll likely either break or higher or lower with shares of Adobe. We'll be sure to take a look at the technicals as well. Hey guys, hope you're doing well out there. It's been a while since we've taken a look at shares of Adobe that are now trading underneath a 30 times forward earnings multiple. So in a market that's absolutely red hot with valuations that are simply not making a whole lot of sense anymore, you have a quality enterprise software name like Adobe that has been trading down over the past year to date, over the past 1 year, even over the last 5 years. You're not up a whole lot, just 81%. So now as we head into 2025, is this one of those names that can begin to outperform other enterprise software names, or will the underperformance like we've seen year to date over the past 1 year, will that just simply continue? Now, from the fundamentals, this quarter looked pretty stellar. It looked pretty much as anticipated over on Wall Street. And this company is really known for its predictability, for its high margin subscription as a service business. And so that level of predictability, similar to what you get with a company like Visa, actually is what you pay a higher premium, at least in the past, which you've paid a higher premium for. Now, at the same time, despite that predictability, you're seeing growth rates begin to decline over at Adobe, at least from a historic perspective. So you got Q4 revenues at $5.61 billion. That was good for 11% growth year over year, beating estimates on Wall Street by $70 million. You also got a bottom line non-GAAP EPS beat of $4.81, beating estimates by right around 14 cents. So if you don't know, Adobe's revenues are really made up of two distinct segments. You have the digital media segment, and then you have the digital experience segment. So the digital experience is the majority of this company's business, roughly $5.3 billion. We'll look to break this down a little bit more, but if you had to know, digital experience really consists of those large enterprise software companies that really are Adobe's largest customers. Those are the ones that can afford really large amounts of contracts year over year that this company tends to continue to sign. Now, you also have that digital media segment that now exceeded $2 billion in net new annual recurring revenue. So that's good to see. You also have remaining performance obligations still at nearly $20 billion. That was good for 16% growth year over year. Very strong over at Adobe. These RPOs, or remaining performance obligations, really give you a bit of insight into the next fiscal year for Adobe and how they see revenues, at least that are on contract right now, begin to pan out. So you're still expecting very strong, nearly $20 billion in remaining performance obligations. Now, from an operating cash flow perspective, you generated nearly $3 billion in this most recent quarter. Again, you're looking at $5.6 billion in total revenues. Nearly $2.9 billion of that goes straight to your operating cash flows. So we'll take a look at that when we jump into the financials. Along with that, though, this company continuing to put that cash flows towards a buyback as they purchased nearly 4.6 million shares in the most recent quarter. Now, from the Q4, those numbers look pretty good, but what is sending shares lower in the after hours, again, nearly, call it 8% in the after hours, in my opinion, is the guidance. So the guidance coming in underneath what Wall Street anticipating. So total revenue for the upcoming Q1 is at the midpoint, call it $5.65 billion. The consensus was for $5.72 billion. So you're coming in, call it $70 million shy of the consensus estimate on the upcoming Q1. Now, one thing I think Adobe likes to do is sandbag the guidance, as they'll come in likely with a beat or at least an inline quarter next quarter. And so even if you anticipate them beating their own estimates, they would really be coming in line to what Wall Street is hoping for, at least at the current time. So you'll probably see some revenue expectations get revised lower, but then Adobe 3 months from now probably come in with a slight beat on those lowered expectations. What they also did was come in slightly higher on the Q1 non-GAAP earnings side, as they're anticipating a midpoint of, call it $4.97. Consensus was for $4.94. So slightly ahead on the bottom line, slightly underneath on the top line. Now, I think Q1 isn't really what's spooking Wall Street. It's the fiscal 2025 target that this company gives. So because this was their Q4, they really paint you a pretty good picture for the upcoming next 4 quarters over at Adobe. And so they're anticipating full year 2025 revenue to be in the midpoint of, call it $23.4 billion. Now, Wall Street was anticipating nearly $23.8 billion. So that would represent another 11% growth year over year. Adobe coming in right around $400 million shy on that midpoint compared to what Wall Street was anticipating. So $400 million is, I'd say, a decent chunk of change over at Adobe from a revenue perspective, because keep in mind, a lot of that revenue flows right down to your operating income, to your net income as well. And so if you're missing out on roughly $400 million of top line revenues, yeah, that will absolutely impact your bottom line earnings per share. And that's exactly what Wall Street is, again, seeing a little discrepancy in, because Adobe is guiding for full year bottom line EPS at the midpoint of $20.35. We take a look at the average estimate on Wall Street, it was closer to $20.53. So that $400 million being shaved off on your revenue side is certainly impacting your bottom line profitability as well. Now, I don't think it's a huge miss where it warrants for nearly an 8 to 10% drop in shares, but I think at a time when other enterprise software names are coming in with beats and raises on the back of an AI narrative, when Adobe isn't able to come in with that sort of beat and raise, that is causing shares to move down much, much lower. Now, they also provide guidance on the share count, which we'll take a look at in just a minute. But again, from a forward guidance perspective, you again are anticipating roughly $20.30 in forward earnings for the next fiscal year, and you're looking at a share price right around 500 times. So if you do the math on that, your forward price to earnings multiple is actually closer to probably 25 times for next fiscal or next calendar year, really. Along with that, the cash flows this company continues to put out, you're looking at a free cash flow yield north of, in my opinion, 3%. And so from that perspective, the valuation over at Adobe is really what makes sense to me. Despite this growth over this company sort of moderating, they're still in the low double digits from both a revenue and earnings perspective. And then now you're looking at a company trading at a forward multiple of 25 times. Again, that's not overly egregious. In fact, if you were to ask me, probably slightly undervalued based on Adobe's historic mean, because again, you have a very high margin software as a service revenue company. Now, the company did mention that they anticipate a revenue shortfall of right around $200 million. That is due to foreign exchange headwinds. And so, look, we just saw this company give guidance that was roughly $400 million shy of what Wall Street anticipated. But keep in mind, $200 million of that is due to foreign exchange headwinds, and then the other is probably due to a smaller impact of the continued move to subscriptions from further perpetual offerings. So this company back, I believe in 2016 or maybe 2017, switched to a subscription and a recurring revenue business model. And so on those existing products that they have, they still probably have a very small section of customers that are on maybe a fixed term and now moving to a subscription, but you have a smaller and smaller impact from that move over to subscriptions, because again, majority of that has likely been realized and seen over at Adobe. So keep in mind, some of that revenue shortfall is simply due to the fact that you have foreign exchange headwinds. Some of it, again, is due to the fact that you have not really a new move from a fixed cost model to a subscription model. Much of that gain has been realized. Now, in this most recent quarter, some of their wins include, in fact, a lot of their wins include some AI models. So in my opinion, the biggest knock on Adobe right now is probably the fact that this company isn't really pivoting to AI, or at least they're not a direct beneficiary of AI, similar to how other enterprise software names like a Palantir, like a Salesforce really directly is. In my opinion, that's actually a narrative that's incorrect, because this company is layering on AI into all of their products, and some of their quarterly wins are really reflected in that. So they layered on multiple Gen AI models in Adobe Firefly, including imaging, vector, along with design, and then most recently added on video. So you can probably go from text to video, also from video to text now with Adobe Firefly. And these comprehensive set of Gen AI models are now designed to be commercially safe for creating content. That's the important word, commercially safe, because you have a lot of Gen AI models out there that are probably good for users or consumers like me and you, which aren't really creating large amounts of generative AI content. We're not really creating marketing campaigns or advertising campaigns using Gen AI. And so for us, maybe sure, it doesn't need to be commercially safe, but if you're an enterprise signing up for Adobe Firefly, really an enterprise wanting to create a marketing campaign using Gen AI, you have to make sure it's commercially safe. It basically has all the video and image rights along with the IP being protected. And so from that perspective, I think for enterprises, Adobe really is still the go-to from a design perspective. Now, along with that, they're also integrating Firefly across their flagship applications in Creative Cloud, also Document Cloud and Experience Cloud, and that is driving record customer adoption and usage. And they have a figure that Firefly powered generations across their tools surpassed 16 billion, with every month this past quarter setting a new record in terms of that Gen AI adoption on Firefly. And then they're also enhancing document productivity by layering on AI Assistant in Adobe Acrobat and Reader as well. So this company, again, layering on AI pretty much across their stack, across digital media, across digital experience, as well as they have Adobe Gen Studio, which in my opinion, again, really for the enterprise, in order for enterprises and marketing companies and agencies deliver content faster, along with that cheaper as well. So in my opinion, while Adobe isn't a company that's directly putting AI as a product out there for the customers, similar to how CRM put out Agentforce, you also have Palantir putting out AI products directly for customers to use. In my opinion, Adobe is instead going down the approach where they're layering on AI across their existing very sticky suite of applications that are, again, used by enterprises, used by freelancers and agencies. They're basically layering on AI across all of those products to probably upsell them a little bit, also to make those products even more stickier and more useful for their customers. So I think this is a different approach Adobe is taking, and that approach, in my opinion, isn't really giving them the same narrative of being an AI beneficiary or an AI enterprise name, similar to how you've seen with Salesforce and of course Palantir. But if you were to ask me, I think that approach Adobe is taking, I think certainly will work for them. It's absolutely going to protect their moat, keep their products extremely valuable and sticky, and probably something that'll keep this business very predictable over the next few years. And that high level of predictability, along with a high margin software business, is why I think you can pay a pretty good premium on shares of Adobe. And right now at 25 times a forward earnings multiple, I think that premium really still has room to expand. Now, financials look absolutely stellar from this most recent Q4. You have total revenues up nearly 11%, like we said, from $5 billion last year up to 5.6 in this most recent quarter. On a full year basis, you had revenues go from 19.4 up to, call it, $21.5 billion. So you added nearly $2 billion on your total revenue side. And then what I want to point out is from a cost of revenues, that basically hardly budged. You went up just $4 million on your cost of revenues, despite adding nearly $2.1 billion on your total revenue. So from a margin perspective, it got a whole lot better over at Adobe. You printed nearly $19 billion in full year gross profit, up from 2023, where you had $17 billion in gross profit. Again, for the most recent quarter, you went from 4.4 up to just underneath $5 billion in gross profit. So you're looking at nearly 90% gross margins right there. Very, very strong business. In fact, in the most recent quarter, you actually saw your cost of revenues declining, despite the fact that you bolstered on nearly 11% on your top line revenues. This is one of the reasons why I absolutely love this company, is because from their financials, there's no way you can poke a hole. The revenues are going up, the cost of those revenues are going down, in fact. And as this company has nearly $20 billion in remaining performance obligations, this sort of performance is something you can continue to expect over at Adobe. Now, those aren't all the expenses. You do have operating expenses. You have R&D taking up right around $100 million year over year. You also have sales and marketing coming up from 1.4 up to now $1.5 billion. You also have some increase on your G&A. But all things considered, you have your total operating expenses go from 2.6 up to $3 billion. And so you still recognize nearly $200 million in growth on your operating income, as that went from 1.7 up to now just underneath $2 billion on the operating income side. For the full year, the growth isn't really as great, as you went from 6.6 up to just 6.7. But keep in mind, earlier this year, this company paid $1 billion for an acquisition termination fee because of that Figma deal falling through. They really had to pay that out over to Figma, I believe. And so that is not a recurring operating expense. And so next year, you probably don't have this company expected to make a large bid where the FTC will probably crack down, and then they'll have to pay an acquisition termination fee. So if you were to strip out this $1 billion cash expense, the operating income would actually go from 6.6 to, call it, $7.7 billion for the full year. So it'd be pretty strong as you bolstered on another $1 billion onto your operating income. And keep in mind, that's on the basis of this company adding nearly $2 billion on their total revenue side. So for every dollar of revenue addition, they're basically getting 50 cents added to the operating income side. Those are juicy margins that this company has now achieved. All things considered, you come down to the net income side. Again, for the most recent quarter, it looks pretty good. For the last year, doesn't paint a great picture because, again, you had that one-time cash expense paid over to Figma. What I want you to notice, though, is the shares used to compute net income, as that is going down from 455 million shares last year in the same quarter, now down to 441 million shares. So this company is certainly doing that buyback. And in fact, in their guidance, they actually outline that in the next quarter, they anticipate nearly 439 million shares. And so continue to expect a nearly $2 million share buyback next quarter. And then for the next year, you anticipate nearly 433 million shares outstanding. That would represent another, call it 7 to 8 million shares being taken off the market. So this company certainly is going headfirst into that buyback. I believe they have still another $18 billion left on that buyback. And again, $18 billion for a $240 billion company isn't something to sneeze at. That's a pretty good sizable chunk that this company anticipates to buy back over the next, I believe, call it 1 to 2 years. From a balance sheet perspective, you got nothing to worry about over at Adobe. You're looking at nearly $7.8 billion in cash along with short-term investments. You don't have a whole lot of property and equipment, as this company isn't spending a ton on building out large data centers or doing large amounts of warehouses. You have a very asset-light software business, and so your property and equipment line actually going down year over year. You do have a fair amount of goodwill. This company likes to do a bit of tuck-in acquisitions. You'll see them pick up some online marketing agencies along with analytics companies every now and then, and so they have a fair amount of goodwill. But again, all of that is balanced out by, call it $1.5 billion in short-term debt, along with $4 billion in long-term debt. So you don't have a ton of debt on the balance sheet. You have the $6.1 billion deferred revenue line, but again, that sort of consists of your remaining performance obligations. So this might be services that Adobe has given out, not yet received payment for, but I think nothing to overly be concerned about. You anticipate that remaining performance obligation figure to come in next year. And so this really only would be a liability if Adobe's customers stop paying this company for their products. All things considered, though, your debt did increase a little bit, I think, as this company begins to renegotiate lower interest rates, as interest rates begin to come down themselves. Probably have nothing to worry about from that perspective either. So balance sheet looking great. From a cash flow perspective, $2.9 billion of operating cash flows. That's over the last 3 months. Same time last year, you had just $1.6 billion in operating cash flows. What I want you to notice is the stock-based comp not really budging all too much year over year, as this company is doing those buybacks. They're also controlling the growth of the employee headcount, and so that stock-based compensation not really blowing out of proportion. And so that $2.9 billion in operating cash flows, they don't really buy back property and equipment. They don't really buy random equity into different areas of the market. They simply return you the nearly $2.5 billion of operating cash flows in the form of a buyback. Last year, it was at $1 billion. So increasing the pace of that buyback, I like that, as the stock is down year over year. And then the remaining $400 million, they pretty much just add on to their existing cash pile of over $7 billion. So from a cash flow perspective, you're basically getting all of the operating cash flows back to you in the form of a buyback. I believe down the road, Adobe will be one of those companies that begins to pay out a dividend. You don't get that right now, but considering how CRM or Salesforce started a dividend, you also had Meta start a dividend over the past year. You also had Google, in fact, start a dividend. I think Adobe is one of your next big tech mature companies that really is seeing its growth sort of slow down, but still producing a large amount of cash flows that they'll probably spit out a 0.5% yield, in my opinion, probably sometime in the near future. Now, from a technical perspective, you're seeing that nearly 9% decline in the after hours, coming down to $500 on the nose pretty much over the past, call it 12 months. You've seen this one sort of wedge out as you've made higher lows outlined by this blue line along with lower highs outlined by this red line. So you've sort of been converging in a pattern of higher lows and lower highs. Now, at some point, the stock will, in my opinion, break heavily to the downside or upside. Certainly, that is not a surprise because stocks do tend to move up or down. But look, if you break through this support at $500, you're probably coming down to $476, $475. You have a decent level of support there from, I'd say back in June of 2023, also from November and October of this year. But again, if you break through that, this is probably a level where you set a stop loss. And if you break through that, in my opinion, you're probably coming down to the low 400s where you don't have a whole lot of support over the past. And you could probably see this one come down south of 400 in a hurry. Now, if that doesn't happen, if you instead come down to this $500 range and you reverse, you probably have a pretty good chance that you break out of this recent high at $550 and you come back here and you retest $600 a share. So certainly if you want to see a reversal in shares of Adobe, you want to see a breakout higher than this previous set of highs, call it right at $560 a share. If you can do that, you come down here and back test this level, that is probably a great sign. And that probably tells you that shares of Adobe likely will continue to move higher. So I would wait for some sort of a reversal pattern before really convincing yourself that the downtrend over at Adobe is over. I would wait for a breakout above 560, see a pullback, and then move higher. Until then, I think you can expect this one to sort of chop sideways. If you really want to come in here and play a trade, you could probably pick up shares of Adobe at this $500 range, probably set a pretty decent stop loss at 478, which I'll mark in this orange line. If you break down 478, you're probably coming much, much lower. If not, I think you can find some footing at this $500 range and see another move to the upside. So you can look to maybe play a quick trade on this one. From a long perspective, I would wait just a little bit more to really see which way this one moves. Certainly shares of Adobe have been weak at a time when enterprise software and really the overall market has been red hot. And so if you see the market cooling off even just a little bit, I think shares of Adobe will continue to move lower and take a beating. So you don't want to jump into this one from a technical perspective at a point when it's a falling knife. Now, from your fundamentals, everything looks pretty good over at Adobe. You are seeing that slow sort of low teens growth on this one, but you also have that earnings multiple now begin to come in, I'd say sub 25 times a forward earnings multiple if you account for that buyback this company plans to do as well. That was my take on shares of Adobe, a very, very strong company in my opinion, but I think the narrative just isn't quite there with this one, at least at the current time. Unlike other software names like Salesforce and Palantir, which are really riding that AI wave, you haven't seen that with Adobe. I think at one point or another, this company's fundamentals and financials will continue to look stellar, and that narrative will begin to change how the stock is viewed. And until then, if you are long-term bullish on Adobe, these are levels where you could continue to nibble and accumulate this one as you eventually, in my opinion, have this one begin to outperform your enterprise software name. So that was my take on shares of Adobe. One I am bullish on in the long term. I think in the short term, you have some headwinds, more so from a technical perspective than a fundamental one. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.